In Technical Analysis 101, we saw the moving averages. In this section of the course, we will dig deeper into the moving averages and learn many interesting and unique ways of analyzing the charts using the moving average. As we have seen before, the moving average is simply the average value of a time period. Let us say, we want to find the average weight of 10 students. How do we find the average? We add up the weights of all the students and divide the sum by 10. This gives us the average weight of 10 students. Some of them will weigh lower and some will have a higher weight. But as we say, on an average this is the weight of each student. Similarly, let us say, we want to find the average closing price of the last 10 days. How do we get the average? We add the closing prices of the last 10 days and divide the sum by 10. This gives us the average price of the last 10 days. Now let us go back to the students in the class. One of the students left and another student joined in the group. We once again have a group of 10. But the new student is slim and slender, and we need the new average. What do? We will remove the weight of the student who left and add the weight of the new student who joined the class, add the weights of all the earlier 9 students, and also add the weight of the new student, to get the total weight of 10 students and divide this sum by 10, to get the new average weight. Something similar happens while calculating the moving average. Assume we want to calculate the last 10 days' average closing price. We add up the closing values of the last 10 days and divide it by 10 to get the average. However, the markets are continuous, and the next day, we have a different closing price. So, on the next day, we remove the value of the first day and add the value of the 11th day and divide the sum by 10. Once again on day 12, we remove the value of the second day, and add the closing value of the 12th day, and divide the sum again by 10. Since we get a new average closing value, and this value appears to move forward, we call it the moving average of 10 periods. When this is plotted on the chart and the points are connected, it appears like a line that moves forward every day. Similarly, we can calculate the average price of any value over any number of periods. 10 days, 20 days, 30 days, 50 days, 100 days and so on. We can even calculate the average value in different time periods, minutes, hours, week, months, quarters, and any period we want to calculate. One important point normally missed. We can even calculate the moving average of high values, the low values, the open values, and even the volume. When we simply add the values and divide it by the number of periods, it is called a simple moving average. Normally called the SMA in technical analysis. So we can have a 10 SMA, 20 SMA, 50 SMA etc. with the number denoting the periods and the SMA denoting a simple moving average. Many more ingenious ways have been devised to calculate the simple moving average. Some usual methods include adding the high and the low of every time period and dividing it by 2, thereby getting the midpoint of every time period's action. This was called the high-low divided by 2. Another approach is to sum up the values of open, high, low and close and dividing it by 4, called OHLC4. We should understand, the only values truly shown by the markets are the open, high, low, close and volume, and every other indicator and study is just a derivative of these values. So bear in mind, price and price action are of paramount importance. As we saw before in Technical Analysis 101, the moving average essentially smooths the price action and dilutes the volatility. Its only purpose is to identify and signal the beginning of a new trend or the end of the current trend. See the chart here and note how the 10-day simple moving average moves along with the price. Many questions arise here. Which is the best time period to use? Should we use a shorter time frame? Or a longer time frame? Should we use the closing price? Or the high price? Or the low price? Should we use only one average or more than one? There can be no true answer to these questions. Markets at different phases respond differently and we should make a deep study to truly understand how the price action along with the moving average reveals to us some hidden messages. After all, everyone looks at the same data. It is how we interpret the data and how we identify the patterns within the data that will make us a better and skilled analyst. The linear weighted moving average. Some analysts have modified the moving average by giving more weightage to the previous period's action than earlier one. Here, the 10th day price is multiplied by 10, the 9th day by 9, the 8th day by 8 and so on. The total is then divided by the sum of the multipliers. In the case of the 10 days linear weighted moving average, the sum of the multiplier would be 55. 10 plus 9 plus 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1 bringing it to 55. The exponential moving average. Many technical analysts tend to favor the exponential moving average, without a true understanding of the subtleties of the calculation. Understanding the intricacies and reasons of refining the indicators will make the difference between a successful trade and a losing one. If the reasons of refining are not understood, then the analyst misses the very core principle that needs to be watched. This is akin to using the butcher's knife for high-precision surgery. The exponential moving average, or EMA as it is usually referred to, assigns a greater weight to the most recent data. This is done by assigning a percentage value to the last days. For example, in a 10-day moving average, we can assign a value of 10% to the last day, 9% to the day before that, 8% to the day before that, and so on. All this becomes very easy with the computer. Simply plot the moving average you want to plot and the computer does all the routine hard work for you. You can also plot as many moving averages as you want. More about multiple moving averages, MMA, later. Some methods of using the moving averages. The simplest method is to use one moving average, and when price is close above the moving average, a buy signal is generated, and when price is close below the moving average, a sell signal is generated. A short-term moving average like the 5-period moving average, or the 10-period moving average, tracks prices closely and prices cross above and below the moving average fairly rapidly. Here, we should also pay attention to the direction of the moving average. When the average itself is sloping down, a sell signal carries more weight, and when the moving average is sloping to the upside, a buy signal will signal a stronger buy. We have seen all of this in Technical Analysis 101. A shorter period moving average produces more signals, and thereby generates more false signals. Digging deeper, you will observe, the longer period moving average performs better when the market is in an extended trend, and gives back a lot more of the profit captured when it changes direction. In other words, we should also note, the moving average performs better when the markets are trending. We will address this when we study oscillators and the different phases of the market. Using two moving averages to generate signals. This technique is called the double crossover method. Here two moving averages are plotted. A shorter period moving average like a 5-period MA, and a longer period moving average, like a 20-period MA, or the more popular 10 and 50-period moving average, are plotted together on the same chart. When the shorter period moving average crosses above the longer period moving average, a buy is signaled, and when the shorter period moving average crosses below the longer period moving average, a sell signal is generated. Using two moving averages will show fewer whipsaws, but it will also lag behind the market when compared to the single moving average. Using three moving averages to generate signals. The triple crossover method. The triple crossover method. Here, the analyst uses three moving averages. For example, he may use a 5, 13, and 34 period moving average. Logically, when the 5-period MA is above the 13-period MA and the 13-period MA is above the 34-period MA, the stock is in a clear uptrend. The 5-period MA is closely tracking the latest prices. So when the 5-period MA dips below the 13 and 34-period moving averages, and rises above them again, markets have essentially pulled back in an uptrend, and are set to rally again, thus giving a better entry, and likely to signal a spurt in the uptrend. The order is reversed in a downtrend. The 5-period MA is below the 13-period MA and the 13-period MA is below the 34-period MA. Once the 5-period MA moves above the 13 and 34-period MA and then declines below both the averages, it signals the ideal time to sell the market. Several more creative ways of using and applying these principles can be conceived. For example, as long as the 13-period remains above the 34-period average, we can assume the markets are in an uptrend, and we could buy when the 5-period MA rises above the 13-period MA, and close the position when the 5-period MA declines below the 13-period MA. Similarly, as long as the 13-period MA remains below the 34-period MA, we could sell when the 5-period MA declines below the 13-period MA, and close the position when the 5-period MA rises above the 13-period MA. Thus, we are essentially using the middle 13-period MA to gauge the trend of the market, and the 5-period MA as a trigger for our actions. When the market changes its trend, from an uptrend to a downtrend and vice versa, the 5-period MA, being sensitive to the most recent action, will dip below the 13-period MA, and the 13-period MA will only dip below the 34-period MA much later. Some traders use the 5-period to close their long positions as soon as the 5-period MA declines below the 13-period MA, and initiate short positions only when the 13-period MA had declined below the 34-period MA, and then if the 5-period MA declines below the 13-period MA, a sell signal is triggered. Here it must be remembered, the moving averages tend to be efficient in a trending market and do not perform optimally in a sideways whipsawing market. Markets are in a sideways choppy direction about 30% to 50% of the time, and thus, the moving averages do not work well for a significant period of time. In a later session, we shall study how to know when the market is trending, or when it is not. This knowledge will arm us with which indicator to use during the different phases of the market.